Welcome to this powerful session on how your mindset shapes your trading results. Today, we're not talking about indicators. We're not talking about secret strategies. We're talking about the one factor that controls everything, your mind. Because before profit appears on your screen, before losses test your patience, your mindset has already influenced the outcome. In this session, we're breaking it down into 5 powerful phases. Phase 1, belief, the invisible blueprint shaping your trading behavior. Phase 2, perception, how your mind interprets and sometimes distorts the market. Phase 3, decision, where mindset turns into action under pressure. Phase 4, habits, the daily behaviors that create consistency. Phase 5, results, when mindset transforms into identity and performance stabilizes. Each phase builds on the next. And if you truly want consistency in trading, you need to understand all 5. So watch this session until the very end, because the final phase ties everything together. If you're serious about mastering trading psychology, make sure you like this video, share it with another trader who needs this, subscribe to the channel, and turn on the notification bell so you never miss the next training. Now take a breath, clear your mind, and let's begin. Every trading result begins long before you enter a position. It begins in belief, not your belief about the market, not your belief about the economy, not your belief about indicators or strategies. It begins with your belief about yourself. Before charts, before strategies, before indicators, before risk management rules, there is an internal blueprint, a silent structure shaping how you interpret uncertainty, and that blueprint influences every decision you make. Most traders believe results are created by setups. They think profitability is hidden in better entries, tighter stops, or smarter analysis. But setups do not execute themselves. They are filtered through perception, and perception is shaped by mindset. If you believe the market is against you, you will interpret normal volatility as manipulation. If you believe losses mean failure, you will avoid necessary risk. If you believe you must win frequently to succeed, you will interfere with probability. Belief is quiet. It does not shout. It whispers, but it directs behavior with precision. 2 traders can use the exact same strategy, same entry, same stop loss, same target, same market conditions. One executes calmly, the other hesitates. One follows the plan, the other exits early. One accepts the loss, the other moves the stop. What changed? Not the chart, not the setup, the mindset. Because mindset shapes interpretation, and interpretation shapes action. If you secretly believe you are bad at trading, every small loss becomes confirmation. You don't see it as variance, you see it as proof. But if you believe you are developing skill, every loss becomes feedback. Same event, different meaning, different emotional reaction, different long-term result. Your subconscious beliefs influence how long you hold trades, how quickly you exit, how much size you use, how you respond to drawdowns, whether you journal honestly, whether you respect your rules. You may say you want consistency, you may say you want discipline, but if you believe deep down that trading is chaotic, your behavior will reflect chaos. If you believe trading requires constant action, you will overtrade. If you believe the market owes you something, you will force outcomes. Mindset is the filter. The market provides neutral data. Price moves, candles form, levels break. But your mind assigns emotion. Your mind assigns danger. Your mind assigns opportunity. And most of this happens automatically, without awareness, without conscious choice. That is why phase 1 is awareness. Because you cannot correct what you cannot see. Ask yourself honestly, do you believe trading must be stressful to be profitable? Do you believe success requires constant activity? Do you believe you must prove intelligence through winning? Do you believe losses mean you are inadequate? These beliefs create tension, and tension creates mistakes. The market does not respond to effort. It responds to structure. It does not reward intensity. It rewards consistency. But if your mindset is built on urgency, you will overtrade. If your mindset is built on fear, you will hesitate. If your mindset is built on ego, you will overexpose your capital. Your results are not random, they are patterned, and patterns are born from belief. Most traders work on strategy first, Professionals work on identity first, because identity dictates execution. If you see yourself as reactive, you will react. If you see yourself as disciplined, you will pause before acting. If you see yourself as learning, you will adapt instead of collapse. If you see yourself as unlucky, you will interpret randomness as attack. Your internal identity becomes your external behavior, and behavior compounds into results. The market amplifies whatever belief you bring into it. It does not create weakness, it exposes it. If you lack patience, the market will reveal impatience. If you lack risk control, the market will reveal impulsiveness. If you lack emotional stability, volatility will magnify instability. Phase 1 is not about forcing confidence. It is about observing your current blueprint. You begin noticing thoughts without judgment. You observe fear without labeling it weakness. You recognize impatience without criticizing yourself. You notice revenge impulses without acting on them. Because belief does not change through suppression, it changes through recognition. When you see the blueprint clearly, you gain power over it. Instead of "I always mess up," you shift to "I am refining execution." Instead of "I need to win this back," you shift to "My edge plays out over time." Instead of "I hope this works," you shift to "I accept defined risk." Instead of "This loss means I'm failing," you shift to "This is statistical variance." This is not positive thinking. It is structured thinking. It is choosing interpretation deliberately. It is responding instead of reacting. And once belief shifts, behavior begins to align. You stop fighting normal losses. You stop personalizing drawdowns. You stop chasing emotional relief. And when behavior stabilizes, results begin to stabilize. Not overnight, but gradually. Because mindset shapes consistency long before profits reflect it. Phase 1 teaches you this. Before you master the market, you must understand the mind that enters it. Because your mindset is not separate from your trading results. It is not a side factor. It is not optional. It is the source, the invisible blueprint. And once you become aware of it, transformation begins. The market is neutral. It does not know you. It does not target you. It does not reward you. It does not punish you. It moves. That's all it does. Price fluctuates. Liquidity shifts. Momentum builds. Momentum fades. There is no emotion inside a candle. No intention inside a breakout. No revenge inside a stop hunt. But your mind does something powerful. It interprets. And interpretation is where distortion begins. Two traders watch the same candle form, same structure, same volume, same price movement. One sees opportunity, the other sees danger. The chart hasn't changed, but perception has, and perception is shaped by mindset. If you enter the session anxious, every pullback feels like a threat. Normal retracements feel like reversals. Healthy volatility feels like instability. If you enter overconfident, every setup looks perfect. Weak signals appear strong. Risk appears small. Warning signs become invisible. The market becomes a mirror. It reflects your internal state back to you. If you are calm, you see structure. If you are fearful, you see traps. If you are impatient, you see urgency. Phase 2 is about understanding a critical truth. You are not reacting to the market. You are reacting to your interpretation of it. And interpretation is influenced by bias. The human brain is not neutral. It is protective. It is selective. It is emotional. Confirmation bias. You search for evidence that supports what you already believe. If you believe price will rise, you highlight bullish signals. You dismiss bearish structure. If you believe price will fall, you emphasize weakness. You ignore strength. You don't see the chart objectively. You see it selectively. Then there is recency bias. The brain gives extra weight to the most recent experience. If you just experienced a loss, your mind exaggerates risk. You hesitate on valid setups. You reduce size excessively. You anticipate failure. If you just experienced a win, your mind underestimates danger. You increase size. You loosen rules. You feel invincible. The last outcome becomes emotionally louder than statistical probability. But trading is a game of probabilities, not recent emotions. Then there is fear-based projection. You imagine worst-case scenarios. Before they happen, you picture the trade collapsing. You visualize drawdown expanding. You exit early to avoid imagined pain, or you avoid entering altogether. not because the setup is invalid, but because perception has been hijacked by emotion. The market did not change. Your nervous system did. Adrenaline shifts perception. Cortisol narrows focus. Anxiety magnifies uncertainty. Perception also affects timing. Impatience makes consolidation feel endless. You interpret sideways movement as wasted time. You anticipate breakouts before confirmation. You force entries to escape boredom. Why? Because your mind interprets stillness as missed opportunity. But professionals understand something critical. The market does not rush. Only traders do. The market moves when conditions align. It pauses when liquidity builds. It expands when pressure releases. There is rhythm in price action. There is structure beneath volatility. But emotional perception disrupts that rhythm. When perception is clear, you see structure. You see higher highs and higher lows. You recognize supply and demand. You wait for confirmation. You respect invalidation. You observe. But when perception is emotional, you see chaos. Every tick feels significant. Every candle feels urgent. Every pullback feels dangerous. Every breakout feels like the last opportunity. Clarity is not intelligence. It is calm. A regulated mind sees levels objectively. An anxious mind sees traps everywhere. An ego-driven mind sees certainty where none exists. Phase 2 teaches detachment from emotional interpretation. You begin noticing your internal dialogue. This looks risky. Price is against me. I knew this would fail. I can't miss this move. Instead of accepting these thoughts as truth, you question them. Is this fact? Or is this fear speaking? Is this structure? Or is this ego protecting itself? Professional traders slow perception down. They pause before labeling. They observe before reacting. They separate what price is doing from what they are feeling. That separation changes everything, because distorted perception leads to distorted decisions, and distorted decisions create inconsistent results. When perception improves, execution stabilizes. You begin seeing probabilities instead of threats. You see setups instead of stress. You see risk as measured exposure, not danger. You stop personalizing volatility. You stop assigning meaning to randomness. Perception training requires accepting uncertainty, releasing the need to predict every move, observing volatility without urgency, detaching self-worth from outcomes, letting structure confirm before acting. The market is not personal, but perception makes it personal. And once it becomes personal, emotion takes control. You defend positions. You argue with price. You feel attacked by normal movement. Phase 2 shifts you from emotional interpretation to structured observation. Instead of, this move is attacking my position, you shift to, this move is testing my risk parameters. Instead of, the market is unpredictable and dangerous, you shift to, the market is probabilistic and structured. Instead of, I need to be right, you shift to, I need to follow my plan. Language shapes perception, and perception shapes action. You are not trying to eliminate emotion. Emotion is human. You are preventing emotion from distorting information. When perception becomes clear, you stop fighting the market. You begin reading it. You stop anticipating disaster. You respond to structure. You stop chasing certainty. You accept probability. But professionals understand something critical. The market does not rush. Only traders do. The market moves when conditions align. It pauses when liquidity builds. It expands when pressure releases. There is rhythm in price action. There is structure beneath volatility. But emotional perception disrupts that rhythm. When perception is clear, you see structure. You see higher highs and higher lows. You recognize supply and demand. You wait for confirmation. You respect invalidation. You observe. But when perception is emotional, you see chaos. Every tick feels significant. Every candle feels urgent. Every pullback feels dangerous. Every breakout feels like the last opportunity. Clarity is not intelligence. It is calm. A regulated mind sees levels objectively. An anxious mind sees traps everywhere. An ego-driven mind sees certainty where none exists. Phase 2 teaches detachment from emotional interpretation. You begin noticing your internal dialogue. This looks risky. Price is against me. I knew this would fail. I can't miss this move. Instead of accepting these thoughts as truth, you question them. Is this fact? Or is this fear speaking? Is this structure, or is this ego protecting itself? Professional traders slow perception down. They pause before labeling. They observe before reacting. They separate what price is doing from what they are feeling. That separation changes everything, because distorted perception leads to distorted decisions, and distorted decisions create inconsistent results. When perception improves, execution stabilizes. You begin seeing probabilities instead of threats. You see setups instead of stress. You see risk as measured exposure, not danger. You stop personalizing volatility. You stop assigning meaning to randomness. Perception training requires accepting uncertainty, releasing the need to predict every move, observing volatility without urgency, detaching self-worth from outcomes, letting structure confirm before acting. The market is not personal, but perception makes it personal. And once it becomes personal, emotion takes control. You defend positions. You argue with price. You feel attacked by normal movement. Phase shifts you from emotional interpretation to structured observation. Instead of, this move is attacking my position, you shift to, this move is testing my risk parameters. Instead of, the market is unpredictable and dangerous, you shift to, the market is probabilistic and structured. Instead of, I need to be right, you shift to, I need to follow my plan. Language shapes perception, and perception shapes action. You are not trying to eliminate emotion. Emotion is human. You are preventing emotion from distorting information. When perception becomes clear, you stop fighting the market. You begin reading it. You stop anticipating disaster. You respond to structure. You stop chasing certainty. You accept probability. And when probability replaces prediction, pressure fades. Clear perception leads to disciplined execution. Disciplined execution leads to consistency. Distorted perception leads to impulsive reaction. Impulsive reaction leads to unstable results. Phase teaches this truth. You are not trading the market. You are trading your interpretation of it. Master perception, and the market becomes simpler. Ignore it, and the market becomes overwhelming. The chart has always been neutral. Price has always moved by order flow. The difference has never been the candles. The difference has always been the lens through which you see them. A single good decision means nothing. A single disciplined trade proves nothing. A single emotional mistake does not define you. What defines you is repetition, because repetition becomes habit, and habit becomes identity. Phase 4 is where mindset stops being something you think about and becomes something you live. Most traders focus on outcomes. Professionals focus on routines, because habits automate behavior. An automated behavior removes emotional volatility. You don't rise to the level of motivation. You fall to the level of your habits. If your habit is to check social media before charts, you enter distracted. If your habit is to scan randomly for setups, you trade without structure. If your habit is to review only winning trades, you never improve weaknesses. Habits shape performance quietly. They operate in the background, and they either support discipline or sabotage it. Mindset is strengthened or weakened by daily repetition. If you repeatedly break your rules, your brain learns that rules are optional. If you repeatedly follow your plan, your brain learns stability. Consistency is not a personality trait. It is a trained pattern. Every day, you reinforce something. Patience, impulsiveness, discipline, avoidance, focus, distraction. Whatever you repeat expands. Habits reduce decision fatigue. When you have a structured pre-market routine, you don't debate whether to prepare. You prepare. When you have defined risk rules, you don't negotiate with stops. You execute. When you journal daily, you don't rely on memory. You rely on data. Phase 4 is about building behavioral architecture. Pre-market routine, defined entry criteria, fixed risk percentage, post-market review, emotional tracking. These habits create stability, and stability reduces psychological noise. Without habits, every trading day feels unpredictable. With habits, the market may be volatile, but you are not. This is the difference between reactive trading and structured performance. Habits protect you from yourself, because emotions fluctuate, but routines remain. On days when confidence is low, your habits guide you. On days when confidence is high, your habits restrain you. This balance is powerful. Most traders underestimate small habits. They look for dramatic breakthroughs, but transformation happens quietly. One disciplined stop loss, one honest review, one patient session, one avoided revenge trade, repeated over months. Habits compound just like capital. A small improvement in behavior, multiplied over time, creates massive psychological edge. Mindset is not strengthened by intensity, it is strengthened by repetition. The trader who journals for 200 days develops more clarity than the trader who watches 200 videos. Because action creates wiring. Every time you follow your process, you reinforce identity. I am disciplined. Every time you respect risk, you reinforce safety. I protect capital. Every time you accept a loss calmly, you reinforce emotional maturity. I execute probability. These internal statements grow stronger through behavior. Habits also reveal weaknesses. If you skip review after losing days, avoidance is your pattern. If you increase size after wins, overconfidence is your pattern. Awareness is powerful, but habit change is transformational. To change results, you don't need a new personality. You need new repetition. You replace impulsive entry with checklist confirmation, emotional exit with rule-based stop, random sizing with fixed percentage risk. Over time, discipline becomes automatic. You no longer argue with yourself. You no longer negotiate with your plan. You execute calmly. Professionals do not rely on feeling ready. They rely on routine. Because habits remove internal debate, and when internal conflict disappears, clarity emerges. Phase 4 teaches this truth. Your mindset shapes your habits. Your habits shape your behavior. Your behavior shapes your results. If results are inconsistent, look at repetition. Because trading success is not built on extraordinary days. It is built on ordinary discipline, repeated consistently. And when habit aligns with intention, consistency becomes natural, not forced. Results are the loudest part of trading. Profit, loss, drawdown, growth. They are visible. They are measurable. They are emotional. They show up on your screen in numbers. They show up in your account balance. They show up in how you feel at the end of the day. But results are not the beginning of the story. They are the echo of belief, the echo of perception, the echo of decisions, the echo of habits. By the time you see a result, the mindset that created it has already been operating for weeks, sometimes months. Results are delayed reflections of internal patterns, and phase 5 is where everything integrates. This is where you stop chasing results and start embodying identity. Because when mindset matures, results stop feeling random. They start feeling aligned. Early in the journey, results control emotion. A win creates confidence. A loss creates doubt. A winning streak makes you feel skilled. A losing streak makes you question everything. Your emotional state rises and falls with your equity curve. But when identity strengthens, emotion detaches from outcome. A win becomes data. A loss becomes data. Nothing more. This is psychological freedom, because the market can fluctuate without destabilizing you. Your equity curve may move in waves, but your internal state remains steady. That is the difference between a trader and a professional. Professionals are not emotionless. They are anchored. Anchored in process, anchored in discipline, anchored in identity. At this stage, you no longer ask, "How much did I make today?" You ask, "Did I execute correctly today?" Because execution is controllable, outcome is not. When identity becomes process-driven, confidence stabilizes. Not the fragile confidence built on winning streaks, but quiet confidence, the kind built from repetition, the kind that says, "I trust my structure, I respect my risk, I follow my edge." This trust reduces anxiety, it reduces overtrading, it reduces revenge behavior. Because you no longer need the market to validate you, you validate yourself through discipline. Phase 5 is integration. Belief becomes empowered. You no longer see yourself as unlucky, you see yourself as responsible. Perception becomes clear. You no longer personalize volatility. You read structure instead of emotion. Decision-making becomes structured. You pause before acting. You execute predefined plans. You accept defined risk. Habits become automatic. Preparation, journaling, risk control, review, all consistent. and results. Begin reflecting internal stability, not perfectly, not instantly, but steadily. You notice fewer emotional swings, fewer impulsive entries, fewer regret-driven exits, more calm, more patience, more controlled growth. The market hasn't changed. You have. This is the final shift. You stop trying to become a disciplined trader. You realize you are one. Identity locks in behavior. When you identify as disciplined, breaking rules feels unnatural. When you identify as patient, forcing trades feels uncomfortable. When you identify as risk-aware, oversizing feels dangerous. This is powerful, because identity sustains consistency. Without constant effort, you are no longer fighting yourself. You are aligned with yourself. Results now become feedback, not judgment. A drawdown becomes refinement. A losing week becomes data for improvement. A winning month becomes confirmation of process. You zoom out. You think in quarters, in years, in cycles. Short-term noise no longer shakes long-term vision. And this is where mindset fully shapes results. Not through hype, not through motivation, not through emotional intensity, but through structure. The trader who once reacted emotionally now responds strategically. The trader who once chased moves now waits for alignment. The trader who once feared losses now accepts probability. Nothing external forced this shift. No secret indicator, no magic system. It came from internal reconstruction, and that is the real edge. Not perfect entries, not prediction, mental stability. Because trading is a performance environment, and performance is psychological. If your mind is unstable, results will be unstable. If your mind is structured, results will trend toward consistency. Phase 5 teaches you this. You don't rise to profitable identity by accident. You build it through belief correction, through perception clarity, through disciplined decisions, through consistent habits, and eventually, results stop being something you chase. They become something you reflect. The market will always test you. There will always be volatility. There will always be uncertainty. But now, you are prepared, because your mindset is no longer fragile. It is trained. And when mindset becomes identity, consistency stops being a goal. It becomes who you are. If this message changed the way you see trading, don't let it end here. Like this video if you're committed to mastering your mindset. Share it with a trader who needs to hear this. Subscribe to the channel for deeper trading psychology training, and turn on the notification bell so you never miss the next session designed to sharpen your edge. Your results will change when your mindset changes, and that transformation starts now.